So one of the calls I get a lot, or one of the discussions I have a lot, is when a potential client calls and says, hey, what's your rates today? And I say, hey, whatever number it is, 17%. And that person replies with, well, my friend down the street got this rate. Why isn't my rate like that? And so what I want to go to is all of the factors that you can control that affect your interest rate. In a future or an upcoming video, we'll talk about market factors and those kind of things that affect interest rates. But now let's talk about the factors within your own loan that affect the interest rates. Ultimately, what it comes down to is risk on the lender. So if your loan is a little bit more challenging, all those kind of things, or there's some credit issues or whatever those kind of things that create risk for the lender, they're going to charge you a little bit more in interest rate because they're putting out more risk in lending you that money. So the first one is your credit. Obviously, credit is a huge factor. The lower your credit score is, the more potential risk you provide to that lender. The higher your credit score is, in most cases, the better rate you'll have. Okay, but if you have a higher score and there's bankruptcies or there's collections or those kind of things, those can affect your rate as well, up or down. But ultimately, credit is a huge factor. And having low credit doesn't necessarily mean that you can't get a loan. What it most likely means is your rate is probably going to be a little bit higher, and it's going to be a little bit more expensive to be able to buy that home. Down payment is a factor. If you're putting more down, again, you're a little bit less risk. If you're putting less down, in a lot of cases, depending on the loan amount or loan type or those kind of things, but if your down payment is larger, typically your rate may be a little bit lower. Again, it depends on the amount of risk on the lender. Let's go into loan program, and there's a few different factors here. Typically, the government loan programs like VA, FHA, USDA have a little bit lower rates than might a conventional loan or those kind of things. If you go up into the jumbo, which are over conventional loan limits, you may have a little bit higher rate, may have a little bit lower rate. It depends on kind of how the lender views that risk. But loan program will play a huge factor. And one of the reasons for that is those FHA, VA, and USDA loans have built-in protections for the lender in case of default, where conventional, if you put less than 20% down, there's mortgage insurance on those loans. But that's almost like using your own homeowner's insurance, where you have to prove that it's basically not your fault that the default happened or those kind of things. So conventional loans are actually a little bit more risky, which is why a lot of times conventional rates are higher. And in some cases, even over 20%, because there's no mortgage insurance, you can see a little bit higher rate, which may not make sense, but that's one of the things that, again, lenders are going to charge based on the risk they have. The length of your loan will affect. So if you have a 15-year or a 20-year or a 10-year, you may have a little bit lower rate than you would if you had a 30-year loan. Now, again, when you do those kind of things, you need to make sure you can afford a little bit higher payment, because of the shorter term, you're going to have a higher payment, but you're going to pay less in interest and all those kind of things over time. Finally, property. If you're using the property as your primary residence, that's a little bit less risk. If you're using it as a second home, risk goes up a little bit. If it's an investment property, risk goes up a little bit. So you're going to pay a little bit higher rates if you're not using the loan as your primary residence. Again, how you're using the property, how many properties you have financed, all those kind of things creates a little bit more risk for the lender. If you're buying a manufactured home or a duplex or a multi-unit property, again, those things may be a little bit higher rates or different rates than the person down the street. If you're buying a condo or a single family home, those kind of things will change rates. So the type of property, how you're using the property matters, all those kind of things. If you're buying land, those kind of things change, again, the risk on the lender. Ultimately, when that person called me the other day and said, hey, why can't I get what rate my friend is getting? Chances are, there's 31 factors that affect your interest rates. And so ultimately, if not everything's the exact same, the rates are going to be different. And it may not be, their rate may be whatever, 3.25, and your rate may be 3.25, but there may be discount points. That's the kind of the final factor. If you choose to, you can pay an extra fee to have a little bit lower rate, and vice versa. You can take a little bit of a credit from the lender to take a little bit and have a little bit higher rate if closing costs are an issue. So ultimately, there's a lot of factors you can control in this. Obviously, the less risk you provide to the lender, meaning your credit's in great shape, you put some money into the loan and those kind of things, you're probably going to have a little bit lower rate. But all those things may not necessarily work out for you in terms of if you have lower credit, those kind of things. So what I would say is reach out to a lender, go over your rate options. Sometimes buying down the rate isn't the best option. Sometimes taking a credit and paying lower fees may be a better option for you as well. So once you apply for your loan, be sure to go over the rate options with your loan officer and find out what your rate's going to be and see if home ownership is right for you.